Okay, it's let's see, it's Saturday at 8 o'clock. Thanks for joining. We're going to go over Netflix. We'll make this hopefully like a weekly thing. And I did my homework, so spent about 2 or 3 hours modeling out Netflix. And to cut to the chase, I found that it's probably fairly valued, maybe a little overvalued is kind of my guesstimation. Still pretty nebulous situation. So my plan for this lesson is I'm going to show you my model, and then I'm going to go through about 4 different models that people emailed me, and I'll tear those apart. It'll be pretty critical. So I feel bad for those 4 people who emailed them, but definitely brave people to give it a shot. So definitely they earned their kudos for doing that. All right, so let's get started. So let's open up the file. I uploaded this to the share drive so you guys can all check that out. And as you can imagine, like a lot of tech stocks, this is sort of a user growth and ARPU question, right? So it's user growth. Netflix has 70 some odd million users, 71 million users. And the question is, when will that stop? Will they get to 250 million users or more at peak? And that's kind of what I've got here, is they will sort of functionally quadruple. Is that the right way to think about it? I should be dividing. Triple or quadruple. Yeah, about quadruple their users from here into 15 years from now. So I'm assuming that there's a pretty fundamental shift towards online television, and that there will be no more traditional, or much less traditional television. But I'm not assuming that there's such a huge shift. As you can see here, I have US penetration for Netflix getting up to about 27%. And I'll tell you why I picked that number. And as you can see, tech investing, there's a lot of kind of predicting of the long term required. If Netflix gets to 50% or 80% penetration, there's no doubt you don't even have to do the math, although you should. In fact, I would say you do have to do the math. Let me take that back. You do have to do the math to tell whether the stock is a long or not. Right now, it's kind of, the stock is assuming that they'll get to about 25 to 27% long-term U.S. penetration. And that means paying U.S. customers who each pay about $100 to $200 depending on the inflation and the year. So we have to analyze the circumstances that might lead to, and how content creators are kind of trying to a certain extent, get their own content paid for without Netflix, and whether or not that'll work. And then Netflix obviously has some competition, the Hulus of the world and others. But the number one thing I looked at for user growth was actually just sort of the velocity. And velocity is a tricky thing. There's a lot of, I'll give you the graph of, let's do a graph of their domestic kind of user growth. So this is from 13 million, so it's kind of interrupted. I didn't go far back enough to know kind of how it was since inception. But if you look at it, it's sort of, and if you do the math in terms of year over years, they're at 15% user growth, which is healthy, very healthy, but you can see the law of large numbers is starting to catch up to them. And certainly for a company like Facebook, whose user growth I mapped out for a long time, you can see Netflix is in the maturity mode, whereas their international business is still in that logarithmic growth mode. And the international business is from scratch, so you can see it from 0 to 25 million, and they're still in that huge step function. The year over year for the international is 64% year over year. So the US business is down at 15% year over year. And I've never really seen these growth functions, once they start slowing down, they don't really stop, especially as they get to teens and single digits. So as an investor, you're going to have to watch Netflix very carefully. But for them to get to, that, 40, 50, 60% long-term penetration of U.S. market, and I drive the rest of the world based on a proxy to the U.S. market. So they would really have I think they would have a hard time doing that. Now, obviously, if they did that for 15% for 10 or more years, that you could get to the inevitably 84%, 84% or so penetration. And then, in terms of international, you'd have something really ridiculous like 400 million users. Now you triple your money or so. That's not a great return for basically you're modeling out that Netflix takes over the world, that people only watch television through Netflix. This is a great way to look at a stock, is if you think, okay, what if the best case happens, right? What if the very, very, very best case happens? How much money will I make? That's a pretty important concept. And here, if the very, very, very best thing happens, which is that Netflix, in essence, almost every American is paying Netflix, and almost every international customer within reason is also paying Netflix. You're looking at, let's do a few more of these just to get a little more realistic in terms of if this would happen. You're looking at making, call it 4 or 5 times your money, which is obviously an amazing return, but you're also talking about something really outlandish, really an outlandish concept. That's going to be really, really hard to achieve. Even 50% penetration, I think, would be a miracle. So let's see what happens at 50% penetration. And you can actually just the cool thing about these models is you can sort of check out what will happen in every circumstance. Here's something closer to 50% penetration, and international typically is going to be double or triple. All right, so this is a pretty sanguine outlook as well. If they got to this level, you would triple your money. It's a $100 stock now, it would be worth $300, and that's if they got half of America and half of maybe the rest of the world to, or at least the kind of industrialized rest of the world, to become paid users of Netflix. So basically, if we just take some notes here, and we're also talking about margins staying the same and all these other things. So let's jot this down in my notepad. Bear with me for 2 seconds. All right. So let's see. So we said that if they get 80 to 90%, so this is penetration, user penetration, just say. Stock is $450. If they get 50% penetration, it's $300. If they get 25% penetration and keep it, it's about $100. Now this is where it's at right now. So the stock price, at least, their penetration in the US is paid about 15%. As of last quarter is 14%. So the stock is assuming that they go from at least 14% to 25% for it to be worth even $100. And that's no small thing, right? I don't like it when I make an investment and the company has to do really, really well for me to even break even, right? To even break even on my investment. That's not a value investment most of the time, right? Value investment, the way I look at it, is the company can, this is an old Warren Buffett saying. He used to say, I like to own businesses that, and I'm paraphrasing here, that even if a moron CEO, maybe someone like me, is in charge, my investment will still be okay. And that's more or less what he said. And the point is that no matter how good the board of directors is, you'll get a bad CEO every now and then. It's not it's just sort of the nature of the beast. And in tech especially, you're gonna, especially if you're hoping on some long-term impact, they're not gonna go from 14% users to 25% users overnight. At least they haven't so far. Now you could argue that broadband is finally at a point where this could, they could have accelerating user growth, which is not a common phenomenon, but there's nothing that's stopping them from, say, for instance, going from 15% year over year to 20% year over year, I'd be really impressed, and the stock would probably go up 20 or 30% if that happened. Everyone's watching this user number like a hawk, because with users come revenue, and with revenue comes profits. And if you pay attention to the near term, Netflix isn't making money. In fact, if you look at their cash flow statement, they lost probably $300 million last quarter. On a GAAP basis, they made $43 million. On my adjustments, they lost about $50 million. Obviously, a company that loses money over the long term is worthless. So they need more users to get to that place. So the stock definitely assumes that they're going to maybe double their user base, which is pretty scary if you think about it. On one hand, the users are growing, but it's not like that they're growing a really enormous amount. They're growing just 15%. So if you did the model the way I did it, I got to fair value if US goes from 14 to 25 and international does a similar sort of growth, a really accelerated growth. So that's sort of a problem. And obviously, if anything below 25%, like if they stopped growing tomorrow and they stayed at 14% US, and then the international finished its growth trajectory to a higher place, the stock would be like $50. And so what are the things that are going to change user penetration? Well, one big thing is content creators are trying to create their own channel. So there's a lot of different kind of content providers, right? So you have, movies, TV shows, etc. And the old channel is sort of TV. The new channel is Netflix and Hulu and others. And so the point is that the content makers are now selling to all of these channels, and it's sort of a zero-sum game if you ask me, because someone's going to lose money because the content providers they sell their content and it's very expensive, right? That's the problem with Netflix. It has 31% gross margins. Unlike most tech companies that have high gross margins, now Amazon has low gross margins too. But the point is that they can't really leverage the content, or it's unlikely that they'll be able to leverage content. As you know, with Making a Murderer, they are getting into the content game themselves. So it's murderer. So they'll occasionally make their own content, but obviously I think the content business has its own issues. Is Netflix going to be as good at content creation as they are about content delivery? The reason Netflix is popular is they have an install base, so people like Netflix, they talk to their friends about it. It's a great sort of user interface, etc. One amazing thing that I saw is that they are the number one in bandwidth. They are the number one bandwidth occupier, if you will, in the United States, which is pretty incredible. They have a number of cool things, content that they've got. Maybe that's their quote-unquote edge. But there's companies like NBC, CBS, and these companies have been in the content business for a heck of a long time. And if you look at their market caps, take some of the very biggest companies, let's say CBS, which I think is a $25 billion company, right? So if you look at Viacom, it's another sort of content media company. It's a $15 billion company. These guys create all of the content. Netflix is just the portal for it. I'm not trying to say that the portal is not valuable. The portal is valuable, but there's Hulu, there's Amazon. There's no shortage of competition. At the end of the day, all you really need to create a Netflix or a Hulu or an Amazon on demand is just simply cash, right? The servers and all of that are kind of, at the end of the day, pretty commoditized. So I wonder if this is really the business of the future, or if you look at kind of the same way cable started, right? Cable went to 90% or so penetration in the United States, and along the way, all of the companies, the Comcasts, if you study the history of cable, this is a good proxy, I would say. In fact, we'll make that as homework. The history of cable television. You had the Comcasts, the Clear Channels. Well, Clear Channel was more radio, so let's see. You had the Comcasts, and the Time Warners, and in New York area we've got Cablevision. And then you had, remember, these companies were all born from other companies through mergers. So let's look up a few of those mergers. Maybe this will work. Charter, DirecTV, DirecTV is satellite, but it's not, you know. Here we go. 2 decades of cable TV consolidation. Here we go. Bright House Networks. Don't know who that is. Mediacom, that was a big one. Cox was a huge one. Charter, Bright House, Dish. So the point is that, you know, no one player really dominated. If you look at, let's look at, you know, the other, let's look at Comcast. Comcast, 140 billion. Let's take another look. Let's see about this one. All right, Comcast got to 146 billion market cap as the largest cable company. So if you think about Netflix becoming like that, it's a 3 or 4x return. Which is a pretty cool idea, right? Basically, Netflix is the future of Comcast, and Comcast is worth 146 billion. The problem is that I think that if you look at Comcast's growth in market cap, it's mostly been driven by acquisitions. You know, the stock price hasn't really gone up. Let's take a look if I'm right about that. Oh, let's see. Yeah, it's gone up, but only really in the last 5 years. Let's go back even further. Yeah, from the 90s, 99 to 2010, it was pretty flat, but yeah, I like this idea. Maybe I'm being too skeptical of Netflix. Let me see if I can find cable penetration. History. 84% right now. So radio, they all had pretty similar growth. See, radio, TV, cable. Where's Netflix? And this isn't the best graph because it doesn't have penetration percentage. It says growth. See if we can get. It a different way. Does this look accurate? Huh. Let's keep looking. This looks pretty good. Doesn't have cable though. And you know, these are such steep growth curves. Netflix is, it's really not that steep. It's, You know, I have a feeling like it'll. Here we go. Here's a good one. Well, this doesn't have cable either. Yeah, cable was pretty slow if you look at this graph. Cable in the 80s is in the 20s. Now is in the 40s. Cable plus ads with pay. Well, here's wired cable was 10% or 5%, and it got up to the 70s. Or the 80s if you look at sort of this. Yeah, Comcast is a diverse company. That's a good point. That is a good point. Well, so if you look at this, let's see. Let's get a couple of things down. So let's see. According to this, in 1978 there was 18% cable penetration, and in 1990 it was 60%. So right now Netflix is at 18% penetration. If they can get from 18 to 60 in just 12 years, I can tell you that that's a pretty good number. That's 11% growth for 12 years, in essence. So it's certainly not impossible. It usually takes several companies to get that kind of growth, and they could be the leader, but 60% market share is tough, because remember, this is the concept of a technology. The entire technology gets from 18 to 60%, and that's all well and good, but for one player to get all of that is unlikely. So it seems to me like the most they can get is a fraction of that. That's an interesting point, Jason. All right, so this is sort of how I came up with my model. You know, I think there's a lot more to be thought about. Again, a lot of tech investing is pretty philosophical. You know, are you going to get from point A to point B? I think there's a lot of risks here, because if you look at the last couple of quarters of growth, the U.S. growth numbers are starting to really flatten out. Now, again, even if it stays at 10 or 15% a year for a long time, I think they'll be fine. But I also don't, you know, you're not going to get a gigantic return unless they sort of have some unique new service. You know, then you might be able to double your money, but it certainly doesn't feel like an easy home run. If they add, I mean, they have a lot of users, they should be able to add some new service, and that's sort of the wild card. It's probably an okay long. You know, I know their biggest. I looked at their shareholder list. I don't typically care about this kind of stuff, but Tiger is a hedge fund that is the largest investment in this hedge fund. I have a lot of respect for the folks that run this hedge fund. So they're pretty bullish, and I think they have been for some time. I don't know how to look at that. Let's see, historical. Yeah, they've owned, well, they just bought it in 2015, so they didn't have many shares before 2015. I know Carl Icahn was a big fan, but I think he might have sold his Netflix. And I don't really care about other shareholders, but the discount rate of 7% I thought was okay. You know, pretty fair. But the more I look at it, I think it's pretty reasonable that they'll continue growth for some period of time. It's possible that they re-accelerate growth. That's what it'll just sort of be very important to watch and sort of see what happens. I have some pretty serious pricing growth as well. I guess the biggest thing that I'm fearful of is content providers creating their own content websites. A lot of TV shows now you can watch just on their website, and it goes direct to the revenue. Ad revenue goes direct to them. There'll be more and more solutions for that, which could disintermediate Netflix. Now, I think that people want to be able to watch everything in one place, so it's sort of one thing that is pretty important. So anyway, let's take a look at some of the models that I got. So here's one from Dan Shannon. Let's see. Okay, so this is just the front page is pretty crappy. First, you want to make it all readable so you can actually read it, right? You don't want to have to look around. So the other thing is everything I like in Arial and in font 10. So this is sort of a mishmash of stuff that isn't very easy to look at. I don't even know where to start. All right, company Netflix, TV, movie, documentary, streaming. Okay, guess so. Competing against many activities during downtime, example, books, video games, and movie theater. All right, that's reasonable. It is entertainment competition. Let's see if you got the shares outstanding right. Well, the shares outstanding is where you would put this, right? Because that's where the market cap is just multiplying the two. The shares outstanding is where you want to mark what quarter you got it from. Same thing with cash and debt, whereas enterprise value is just the subtraction addition of the two. You got all the numbers right, but the formatting is wrong. You want no decimal points, because if you have decimal points for this one, but you don't have decimal points for that one, that doesn't really make any sense. It's kind of hard to read. You want them all sort of the same. Stock price, obviously, you're going to have 2 decimal points. But the others, there's no need to know that there's $2,310,000,000 and $390,000. It's just 2.310 billion. I like that you took the notes here, but I think you should just take these notes and put them in the model. Like, it added 3.6 million users in Q3. I don't know why you need that. You could just put that in the user numbers in here, right? And you have them in here, so there's no need to take that note, if that makes sense. Let's see. This is pretty interesting. So 40% contribution margin by 2020. Now, contribution margin is different from margin, but I think that they mean 40% margin. It's hard to tell. If they got to 40% margins, I don't think that's maybe it's what they mean. Let's take a look. Obviously, if they got to higher, I have them at, let's take a look. I don't have them getting anywhere near that kind of margin. So I got them getting to 25% margins. So if they got to 40% margins, then the stock would definitely be along. I just wonder if, the problem is all their content costs quite a bit. Contribution margin generally means what does new revenue, how much of it goes to the bottom line. So let me show you what that looks like. So what that means is that if you subtract these two, so that's an increase of revenue of 1.354 billion, how much does operating margin increase? And here operating income is 400 million, so the contribution margin is 28%. So let me show you. In fact, we can actually make a contribution margin line. So this is a kind of complicated concept. It's not that complicated, but a lot of companies don't use it. But in this sort of user and sub business, you kind of want to do it. So contribution margin it's a measure of kind of efficiency and fixed cost, spreading revenue over fixed cost. So contribution margin is just simply revenue new minus revenue old, and this is all sort of like this, operating income new minus operating income old. So this is what contribution margin is. And the concept is that your fixed costs, you're going to build this business and this big fixed costs and incremental new users, incremental revenue is not going to change the fixed costs. There's not going to really be any change relative to large increases in revenue. That's why this business model is an exciting idea. I think the problem is if the content sellers basically say, look, I noticed your users went from 40 million to 100 million. You've got 100 million people watching my stuff. I want 2.5 times the cost. So I don't know that their margins are really going to grow that much. It would seem difficult. Now Netflix could also say, with that kind of power, they could sort of say, well, we got a lot of users, and you know what? I'm going to show a different network than your network because I don't need you guys. And I think there's probably some truth to that. So if they can get to 40% contribution margin by 2020, that'd be very impressive. I don't know that that's likely. So if I give them 35% gross margins in the long run, that definitely eases the burden for sure for the growth requirements. They may not need to grow so much, so fast, and allow for whatever competition that may exist. So the stock could be a double if they roughly double their user base and have about 3 times the US users globally and have quite good revenue growth and good margin growth. All of that is sort of a really nice, well-managed situation for Netflix, right? They go from, just to compare their 2015 to 2020, they go from $7 billion in revenue to $25 billion in revenue and no profits to $5 billion in profits. That would be a Herculean situation, and you get a $230 stock instead of a $100 stock. Meanwhile, you have all kinds of risk. Now, the risk isn't as high as maybe I'm making it out to be. I mean, when you have 71 million users using your product, it's more likely than not that you're going to be able to hold on to them or grow them. So the discount rate is pretty fair. It could be even a little lower. There's no doubt that the wind's at their backs. But in any event, let's take a look at some of these models. This could be fun. I'm going to tease you guys a little bit. So yeah, one font for the whole model, and Calibri is kind of, I guess, Microsoft's crappy font. This is a model from Neil Stanford. I don't quite understand this. This makes no sense whatsoever. You have cash. This is supposed to be $2.5 billion of cash, right? And $5.9 billion of debt. They don't have $5.9 billion of debt. They have $2.4 billion of debt. It looks like this guy has trouble reading, which is a fundamentally important skill. Let's see. So you can see this is the balance sheet. As of December 31st, 2015, long-term debt, $2.371 billion. But you have 5.901. That I don't understand. Looks like you took current liabilities. Liabilities and debt aren't the same thing. Liabilities are all of your liabilities. Debt is just one kind of liability. Debt is when you borrow money. These liabilities are different. They're different. They're not borrowings. There's only one borrowings on this sheet. So this was a big mistake. The bigger mistake is that this is in millions and this number is in thousands. Everything has to be in the same magnitude. So that's another big fail. Here, I don't understand what you're doing here. These are all from the same statement, all from Q4 2015, so it should all say just Q4 15. So that's pretty easy. So basic errors here. All right. Could Netflix eventually add revenue from advertising? That's an important question. Like I said, I think the wild card is not just advertising. Could they add some other thing to their business, like social networking or some other features, not just being a content curator and provider? Netflix growth internationally may increase with the availability of infrastructure. That is totally true. Pricing is a fundamental part of any business. Netflix share of the broadcasting media industry. Yep, that's definitely important. Observation. It seems that income is going up while free cash flow is declining. That is certainly the case. And based on this first sort of take on the balance sheet, I would expect this guy to be a complete idiot. These are actually kind of pretty smart observations. So let's see. Net income is going up. It's not really going up, to be fair. But free cash flow is definitely declining. They are spending enormous amounts to keep acquiring and providing original content. So that is sort of my point, is that if they don't, they have a 31% sort of gross margin, but if you look at their actual business, the operating margins are negative. So even though the gross margin's positive, you know, some of the things like G&A, sales and marketing, and R&D, I mean, I kind of think of R&D as part of gross margin in this case. You know, so if you put that in, gross margin's pretty close to zero. So, in any event, let's see. I was generous with my sub growth and margins, and even with that, Netflix needs to grow quite a bit. Yeah, that's what I said, very good. The wildcard here is how well their expansion to China will be. Yeah, so the problem, I don't give them credit for China because I do think that Alibaba or some other regional player will do better in China than them. Whether it's drugs or internet, there always seems to be regional players that do better than American companies. All right, 4. It seems to me that in English-speaking countries, such as many European countries, Australia, etc., they have an advantage because their existing successful content can appeal to more people. It seems to me. Yeah, that sounds about right. Yeah, that is a good point. That is a good point. That is a very good point. Yeah, I think they will have to acquire new content for those countries for sure. Why is Netflix net margin so low? Good question. All right, here's the model. Wow. Okay. So, first thing is you want kind of a line in column A that's there, so you can read. You never want, like, I don't know why you have the first 8 rows just kind of. I don't know what any of this stuff is. I would include the dollar sign. I think we know we're using US dollars. It's all just like hard to read. The interest should go away over time. They'll pay their debt back. So that's sort of another mistake they made. Though they should start generating interest income, right, as their income grows. Not sure how you're getting this marketing cost. This is interesting. 25% of revenue. I don't know. Yeah, it's a little hard to read. And I think that assuming that their international members will equal or be just slightly ahead of their US members doesn't sound right. I think they'll have way more international members than US members over time. Discount rate of 8% is reasonable. Let's see how you're discounting it. Again, you need to freeze panes, so that allows you to like still know what year you're in. If you freeze the panes like here, you can still know what year you're in when you scroll down. That's why you shouldn't have all these cells up here. All right, let's see. So discount rate of 8%. Yeah, you're getting the same number that I got, you know, assuming that they don't, you're kind of doing it the reverse. You have like 200 million users or 179 million users or whatever. You should have the number somewhere. So you have 186 million users. Your discount rate's a little high. And you have this op-inc issue. But, and again, like I said, I don't think international will just be a little bigger than US. It will almost always be quite a bit higher. And again, I'm not going to fix all your formatting. GNA won't. This is a huge error here. GNA growing, or 15% of revenue. That's not the way it works. You know, I think that you'll have. I mean, GNA is literally like audit, legal, headquarters costs. This shouldn't be a function of revenue. This is more of a year-over-year concept. GNA should, at huge scales, GNA should be pretty efficient. R&D is kind of similar. Marketing is not. Marketing does drive revenue, but R&D and GNA is kind of business model based more than percentage of revenue based. So those should decline over time. So let's see, my model in 2030, how much revenue do you have? 29 billion. Let's see how much I've got. Let me open mine. 2030, I've got 48 billion. And then for operating income, you have 5 billion, and I have 15 billion. When I have 35, let's see, when I have 29, I have like 7 or 8 billion, 7.5 billion of pre-tax. So that's my point, is that these numbers are a little screwy in terms of costs. Where do you have gross margin? Like, I don't see that either. I need a gross margin percentage somewhere. So it doesn't look like you're really carefully following my lead. So here you have gross margin of 40%. You don't really explain how their gross margin jumps miraculously from 30 some odd percent to 40%. Here you have it for 1 year, I guess, down here, but that's, and you're calculating it wrong. Cost of revenue over revenues, it's gross profit over revenues. So this is, you got the opposite. So a lot of errors here. Not a good job at all. And not very readable, like I said. Kind of poorly done. But, you know, conceptually, I think you're thinking about the right things, which is more important. You can figure out how to do the Excel stuff later. But conceptually, I think you've got your sort of head screwed on in terms of, like, some of these things that you're thinking about, I think are pretty impressive. Yeah, and if you're just thinking about Europe, then I don't think you got it right, because there's tons of other countries, you know, South America, India, the Indian subcontinent, Eastern Europe, Africa, Asia, non-China, like Japan. So I think, you know, it's you're not giving enough attention to the international, but you kind of conceptually have the same ideas as me. It's clearly not a blockbuster, no pun intended, long investment. I think that's somewhat obvious, but, you know, there's a lot of smart hedge funds buying. You don't necessarily think that means anything, but Tiger knows tech, I think, better than anyone, and it's the biggest investment in their entire portfolio. Now, they could just be wrong. There's nothing that would prevent that, but it's definitely makes you stop and think a little bit more. All right, so we talked about Dan's front page. Let's talk about his model. Again, you've got like different fonts, it looks like. Or no, maybe not, but different formats for different numbers. Like here you've got this format, the custom format, and here you have the number format, and it's just like disorienting to me. Like here it's left adjusted or not adjusted, here it's like right adjusted. It's all just Then here you've got 4 decimal points for net income for some reason. And you've got none up here. I don't need 4 decimal points. It's sort of pretty terrible. For percentages, again, it's not meaningful information to have two decimal points. 17% or 17.02%, they're the same thing. And one is a little easier to read. Just 1 decimal point would be good. Let's see how your model shaped out. All right, so similar kind of conceptually. Total revenue getting to 21 billion. Net income of 6 billion sounds reasonable. Gross profit of margins of 50% somehow. I don't know. That sounds crazy. That's where I think you're a little wrong. 50% gross margins. Interest expense. Hold on a second. I'm very confused here. All right, 6 billion. 7% discount. NPV. Yeah, I think the margins are too high. You know, I have this amount of net income with double the revenue. So you have to explain how and why you think those margins are going to grow so much. And you're driving it the wrong way. This cost of revenue doesn't make any sense. You should be forecasting using a gross margin number, because they have to pay their content makers, presumably based on their user base. The content makers will say, all right, I made a TV show, how many people are you going to show it to? They're going to say, all right, this is how much I'm going to charge you. I don't think they can get the, I don't think they can, if they take over everything, the content makers are going to charge them the same thing they charge the cable companies. I mean, think about it. If you're a content maker and Netflix replaces cable, you're going to charge Netflix whatever you were charging the cable companies. That makes sense, right? If you're ESPN, you're not going to, so it'll cost more money as Netflix gets more popular. So their margins, I don't think, will improve very much at all, to be honest. So I think unless you sort of specify why you think gross margins will literally double, this model sort of suffers terribly from that error. All right, let's see who else. Kyle sent me this model. Again, I can't read this without moving over, but it looks like you got the cash and debt stuff right, and all the formatting was right. That's good. And this was kind of the best front page yet, because it had the DVDs section, which is, do people still buy these? LOL. Definitely a 10 out of 10 there. Thank you. Hulu is 9 million, so that's great. I didn't know that. And 20 million. Well, I guess all Amazon Prime, right, is streaming. So it's really Netflix versus Amazon, and Hulu is kind of third place. And this is nice that you put that there. No one else put Hulu at 9 million, so that's pretty nice. That's really good. You have to write key press release info. I would assume that anything you're writing here is key info. U.S. sales are slowing. Yeah. If the market's truly saturated in the U.S., the stock is a short, for sure. I think the market will keep growing in the U.S. That's why I'm hesitating to say it's a short. I mean, if you think about it, Netflix, let's look at that Google, what's that Google Trends? Let's look at that Google Trends for Netflix. Let's see what that looks like. Should be at all-time high, exactly. I think Netflix is just gaining more and more momentum, to be honest. I think they're gonna get a lot of share in the U.S. So that's why I'm very hesitant to say it's a short, and I can't tell when that'll stop either. And that's the problem with technology; it's extremely unpredictable. Amazon Prime, the content providers themselves, I think, are the key competition. You know, again, watching the OJ show recently. I watch it straight on the FX Network's website, and you're going to see HBO Go and all these other content providers kind of just have their own deployment. All right, so here's your model. It's a little better than most. You're still using Calibri 12, which I think is the gold standard is Arial. You don't freeze your panes, which is a huge mistake. As you can see, I can look it down here, but I don't know what quarter this is. What quarter is this? I don't know. I have to guess. That's not useful. Then I have to look back up, then look back down, then look back up. This is basically worthless. So if you go Window, FF, Alt W, FF, freeze panes, or you click up here, it'll freeze it so that I can see, this is Q3, this is And if someone hands me a model that I can't even read, I don't even look at it. So what is this? M year over year. This is marketing year over year. Well, why not copy and paste this for several quarters? That doesn't make a lot of sense, does it? And here, you need to adjust these. Like, there's a lot of little details. And if you have a process, all your models will come out looking the same, like mine, really good. Very uniform. You see, every format's the same, everything's readable. And you need some kind of uniform format, or otherwise it'll kind of be a disaster. So this guy, Barack Osama, didn't use his real name. I don't know what he's doing. This is all in thousands. I think in millions is a good idea. This should be from Q4 15. Let's see about this. Whoa. So this is zoomed out. I would keep it at 100. This looks pretty good. I don't know about this. This looks like a big mistake. Shares for Q4. All right, let's look at NPV. Wow, just a total whiff here. Couldn't do it. 10% discount rate's a little high. You have a very bearish outlook on Netflix here. So you think the whole company is worth $1 billion or $2 per share. All right. There's a lot of people who disagree that's going to go from 98 to 2, but these things do happen. And they certainly do happen. All right, let's look at Kyle's model. What would he come up with? $164 a share, so a little bit higher than right now. Let's see how he got there. Well, his gross margin's appropriately low, but his revenue of $72 billion seems rich. Looks like he's got the idea for operating expenses. All right, so I think the winner is Kyle. I think he had the best model. Not pretty. Actually, I take it back, because he's growing revenue without doing the user stuff. So forget Kyle. Actually, this is garbage. You can't just say, I'm going to think it's going to grow 17% a year. You got to be able to show why, because if you just do this, you can forecast this in perpetuity, and you'll never realize that there's a boundary of some kind. There's some sort of bound. You have to research, how did Facebook, where did they stop? Facebook has sort of stopped growing at about 50% of US users. So that would be a reasonable way to look at it. But cable is another way to look at it, right? Cable got up to 60 to 80% penetration. But again, not one company can't have all that share, so this guy's model is just a little wacky. I mean, Netflix is going to grow. They're not going to stop growing, and that's, again, I don't know what this is. You have them declining by 2%. Meanwhile, their user growth is like enormous, like 30% user growth. So I don't know how total revenue is going to decline by 2%. That doesn't make any sense. If their users are growing by 20 or 30% a year, how could their revenue decline? So I hope that gave you some stuff to think about. No one had a really good model, but that's okay. So why don't we try doing another company together? Maybe you guys can vote. We'll do another US company, because that was pretty hard for most people. A foreign company would just be practically impossible. We can do Priceline, we can do Expedia, we can do Priceline or Expedia or Yahoo. Priceline, Expedia, or Yahoo. What do you guys think? A lot of these are foreign. And I don't want to trick or confuse you guys. Alright, let's do Yahoo. Let's do Yahoo. That'd be fun. Alright, so this time, same place, same time, next week, 8 o'clock. Have your Yahoo model ready. Email it to shkrelimartin@gmail.com. And, if you email it to me, I guarantee you if you go through the effort to email me your model, I'll give you personal advice on it, show you what you did wrong, etc. I love finance. I love looking at forecasts and numbers. I love hearing what you think about companies. It's a lot of fun. So feel free to do that. And I'll have my own Yahoo model ready next week, this time next week, 7 days from right now. All right, so thanks a lot for joining. I hope you learned something. And next time I'll also have a little bit of a lesson plan. I'm going to go through some of Warren Buffett's teachings in addition to doing the Yahoo thing. So maybe we'll try to get like a 2-hour session. Maybe I'll do that tomorrow. I don't know. Stay tuned. It's pretty impromptu, as you guys know. All right, thanks again. Have a good one.